Welcome back to my channel. In this video, we are going to be discussing a very important part of the Forex markets or the financial markets at large, which is market structure. Market structure is one of the most important concepts that we cannot actually explain the great impact it has in making decisions in the market. So the knowledge you have about market structure play a very important aspect in your journey of being a profitable trader. So for you to make some decision in the market, in fact, any decision you want to make in the market should base on your knowledge of what the market structure is saying. So if you don't have the knowledge of market structure, you cannot possibly make good decision or good trading decision in the market. So market structure is very, very important because it is what the market is doing that you want to follow. There's a popular saying that states the trend is your friend. All right. So if you are not following what the market is doing, there is no way you can make money from it. And how do you want to follow what the market is doing? Is by the knowledge of market structure. So if you are new to this channel, please, I will encourage you to subscribe to it so that whenever we post important concepts like this, you will get the notification and hit the like button. So without wasting our time, when we talk about market structure, we are referring to the behavior of the markets and how we can use that behavior to make trading decision. Okay, so the market can do either of these three things. It's either the market is buying, or the market is selling, or the market is consolidating. When we talk about a buying market, this is how it looks like. You see the market rallying to the upside. And when we talk about a selling market, you see the market rallying to the downside. But when the market is consolidating, you see the market's confined within a zone, and it's just creating. You can neither say the market is buying nor it's selling. It's just within a zone, making a zigzag move in this form. Okay, so when a market is buying, we can refer to that market as a bullish market. And when the market is selling, we can refer to that market as a bearish market. So in a similar way, this can be referred to as the consolidating market, or what, a ranging market. Okay, so we are going to look at the characteristic of a bullish market as well as the characteristic of a selling market. How do you know when the market is bullish? What are the features? What are the characteristics? What are the things you need to do? You need to look out for when you are considering a bullish market, and what are the things you need to look out for when you are considering a bearish market? So we are going to look at that. For a market to be bullish, there are a few things you need to consider. Number one is that, okay, before that, I need to show you how a bullish market looks like. You see something like this. Okay, you see the market with this behavior. So this is how a bullish market looks like. The market starts from a point of a low. This particular region is the low point. The market starts from a point of a low, creates a high, creates a low that is higher than the previous low, and then finally creates a what? A high that is higher than the previous high. So we call this part, just to label it for you to understand what you're saying, this particular leg is known as the low. This is the high. This is the lower high. Sorry, a higher low. This is a higher low. Okay. And this part is known as the higher high. All right. So this is how a bullish market looks like. So I told, for you to identify a bullish market, there must be a low. That low should be able to create a high. After the high is created, you will see a higher low. The reason why it is called a higher low is because there was a previous low. This is also a low, but because of the fact that this particular low is higher than the previous low, that's why we refer to it as what? The higher low. And you know, there's a high here before this new high was created. And because of the fact that the new high created is higher than the previous high, That is the reason why we refer to this point as what? The higher high. And then another characteristic of a bullish market is there must be a continuous break of structure to the upside. Okay, there must be a continuous break of structure to the upside. What I mean by break of structure is this. All right, the break of structure happens when the previous high is taken to create what? The higher high. So for just to see how a bullish market is, this is how it looks like in general. This is the low, the lower high, the higher high, the lower high, sorry, the higher low, like this, like this, like this. Yes, this is how a bullish market looks like. And the break of structure is continuous, all right? This is a break of structure, a break of structure, a break of structure, a break of structure. So I've told you, for you to identify a bullish market, the first thing I said is that there is a low that must be identified. And then after that low is created, there should be a high. After that, there should be a higher low, which means that the next low must not be lower than what? The previous low. So it must be higher. That's why we refer to it as the lower high. Then the next thing we say is what? A higher high, a higher low, a higher high, a higher low, a higher high, a higher low, and a higher high. All right. So this is how you identify a bullish market. So like I said, for a market to remain bullish, there must be a continuous break of structure to the upside. Okay. And that is what I've identified by all these lines you're seeing. So that's about bullish markets. Now let's talk about bearish markets. So how do we identify a bearish market? This is how a bearish market looks like. You have a high. After that, you have a lower high, and then you have a lower low. Okay, so for you to identify a bearish market, there must be a high. The market starts from a higher point here. After that higher point is created, there is a low. After that low is created, there is a new high, but that high is lower than the previous high. All right, so we refer to it as what? Lower high. And then finally, there is a lower low. The reason why it is called a lower low is because after this first high created this low, the next low that was created is lower than this previous low. That is why we refer to this part as what? The lower low. So these are the features you use to identify a bearish market. Now, another thing you need to note is that for a market to remain bearish, there must be a continuous break of structure to the downside. For a market to remain bearish, there must be a continuous break of structure to the downside. All right. So another very important aspect of this whole market structure that you must consider is the law of price action. Okay. One of the basic law of price action states that for every impulsive move in the market, there is always a retracement or a pullback. Okay. What it means is that when you are in a bullish market, all the move, remember when you're in a bullish market, you're expecting a break of structure to the upside. All the move that breaks structure to the upside is known as what? The impulsive move. Why the move that created the higher low is known as what? The pullback or the retracement. So in a similar way, when you are in a bearish market, the move that created a break of structure to the downside is known as the impulsive move. Okay, while the ones that created that lower high is known as the retracement or pullback. So in this scenario, this is what we refer to as what? Break of structure. Okay, this is a break of structure to the downside. So that is that. But for you to see a typical example of how a bearish market looks like, you will have to identify it with this diagram. So this is how a bearish market looks like. You have a high, after that a higher high, sorry, higher low. You have a high, a low, a higher low, a lower low, lower high, lower low, lower high, lower low, lower high, lower low, in that order. Okay, like I said, this is the high, a low, a lower high, a lower low, lower high, lower low, lower high, lower low, lower high, and then lower low. So for a market to remain bearish, there must be a continuous break of structure to the downside. Okay, this is what I mean by the break of structure. Okay, all these are known as what? Break of structure. And I've told you what the law of price action said, that for every impulse, there must be a correction or retracement or pullback. Okay, these are all break of structure. Break of structure to the downside, break of structure to the downside, so, and I told you that the move that created that break of structure is an impulsive move. Why the ones that created the lower highs, they are known as what? The retracement move or the pullback or the corrective move. Okay, so that is that about a bullish market and a bearish market. Like I said, when we talk about consolidating markets, it is confined within a zone, just creating a high and a low, a high and a low, a high and a low, a high and a low. There is nothing, you cannot tell the direction of such market. So we refer to such market as what? Consolidating market or ranging market. So this is how it looks like. And you have it within a particular zone. You cannot tell whether the market is in a bullish move or in a bearish move. So this is how a consolidated market looks like. And I hope you understand the basic concept of market structure. So in our next video, we'll be talking about how we can mark out your structure on the chart. So if you want to see that video, please make sure you subscribe to this channel, and then you get notified once the video is ready. Thank you so much for watching.